Welcome to the EY NextWave Private Equity podcast, where industry leaders come together to discuss emerging opportunities and industry trends shaping the global private equity landscape.
Hi, everybody, and welcome to the May edition of the PE Pulse podcast. Our intention here over the next 8 to 10 minutes or so is really just to give you a quick rundown of some of the things that we're seeing in the private equity space, right? So all the important themes and trends and how today's macro environment is impacting private equity in terms of deployment, in terms of fundraising, financing, and just some of the longer term impacts that we're seeing. My name is Pete Witte, and I'm the lead analyst for PE here at EY, and I appreciate you taking the time to listen. So we'll start off by talking about deals, right? Because that's where everybody's really focused right now. A few months ago, when we last talked, we were dealing with an environment that was defined by high inflation, challenges in financing deals, and really just a lot of macro uncertainty that was leading up to a lot of valuation mismatches. And that hasn't changed, right? Those dynamics are still very much present and at the forefront of everybody's mind. Now at EY, we do an annual survey of PE CFOs. So we go out, we talk to more than 100 private equity CFOs. And in that survey, more than half of the folks said that a recession was their number one concern right now, right? It was ahead of valuations. It was ahead of competition for deals. It was ahead of all the political pressures, and certainly the instability that we've seen in the banking system over the last few weeks. Well, that certainly doesn't help either, right? It puts immediate concerns around risk management in the forefront, and it pulls focus from longer-term value creation opportunities and opportunistic deployment. So there's a lot of volatility out there, right? And that's the environment that private equity firms continue to operate in. So where does that get us then in terms of the types of deals that we're seeing? Well, from an activity perspective, in the first quarter, we saw firms announce deals valued at about $90 billion. Now, that's a pretty steep decline from the $240 they announced in the first quarter of last year, but it's about the same as what they did in Q4. Now, what's kind of interesting, though, is that activity picked up pretty significantly as the quarter progressed. I looked at the numbers in January. I said, oh my gosh, $12 billion. This is pandemic level activity, right? But by March, we were up to more than $60 billion, right? So just a really choppy market right now, where some months we're seeing some really low volumes, and then the next month, much more of a spike. Now, the deals that we're seeing are pretty bifurcated, right? Think about a barbell, right? Where on one end, you've got a bunch of smaller middle market deals. And then on the other end, you've got these big take private transactions, right? And there's not necessarily a whole lot in the middle. At the smaller end, we see a lot more add-ons, right? So typically the market is about 50-50 between platform deals and add-ons. Right now, it's about 2/3 in favor of add-ons. And then I think we see, just anecdotally, minority stake deals, right? Where maybe a seller doesn't want to sell their whole business into this market because the valuations are a little disjointed. So they say, okay, it's a good time to take on a minority stake investor. So that accounts for a lot of the volume that we're seeing right now. Now, when we talk about the value of deals, right, and where the bulk of the capital is being deployed, it's altogether different, right? And frankly, I think this is one of the most interesting things that we've seen in a while, right, is this hard pivot toward take private deals. In an average year, take private deals might represent 20% of total PE activity by value. And then last year, as stock prices fell, it was about 40%. First quarter of this year, 80% of PE activity by value was deployed in take private transactions. That's by far a record. If you look at a list of the top 10 deals this year, all of them are take private deals. 16 of the top 20 are take privates, right? So it's a pretty remarkable dynamic. And I think it just kind of underscores the degree to which firms are really trying to stay disciplined and how they're really looking for opportunities to invest in high quality assets that they think are temporarily mispriced. So that's what today's market looks like. Now let's take a few minutes to talk about what we think it actually means. First and foremost, we know that it elevates the significance of operational value add, right? When we think about today's operating environment, we know that debt is less widely available. It's become more expensive. Average new issue rates in call it 10 to 11% range, sometimes higher than that. And that multiple expansion is a lot less likely, right? And so to a large degree, it's really operational value creation that's going to drive those returns. And certain levers in particular come to the forefront in times like these. So for example, if you talk with our working capital people, their phones are ringing off the hook right now, right? Because periods of increased volatility always elevates the importance of having strong discipline around cash, right? As a private equity firm or a portco, you need that visibility into your liquidity needs and your cash position in order to really have full control over the business. And that builds resilience in the business, right? Which of course is critical right now. But it also gives you the opportunity to be very strategic when your competitors are being very defensive. Cost takeouts, that's another, right? Somewhere in the neighborhood of $500 billion in debt is maturing for portfolio companies over the next 2.5 years. So that adds a lot of urgency around maintaining your EBITDA. So how do you stay lean and efficient? How do you keep your input expenditures in check at a time when prices are rising? And most importantly, how do you do all of that in a way that doesn't impede your growth drivers, right? So these levers are always important for private equity, but now so more than ever. And we're seeing a doubling down given the market environment that we're in. The other thing that periods of excess volatility tend to do is to catalyze emerging trends and new market innovations, right? And it's highly likely that today's conditions will provide some tailwinds to a number of evolutions that are already underway in the private equity space. So we've talked about private credit before, for example, and how last year when PE's traditional lending sources stepped away from the market, private credit funds stepped in as a major source of alternative funding for a much larger swath of private equity deals. The recent banking instability that we've experienced is likely to exacerbate that trend, right? So credit funds continue to work together on big deals, and they'll ultimately take some measure of share from the broadly syndicated loan market, even after those markets normalize. According to S&P Leveraged Commentary and Data, of the 73 deals that they tracked in the first quarter this year, only 4 of those were financed by the syndicated markets. That's really remarkable. Another, I would say, is the secondaries market, right? So constraints in private equity's traditional exit routes are going to be a tailwind there. And the last several years, we've seen, explosive growth in that space. But still, despite that growth, it's just a fraction of the size of the overall market for primaries. And you think about the market for other financial products, that's in sharp contrast to those markets, right? Where secondary trading is magnitudes larger than the primary market. And then lastly, I'd say as fundraising becomes more challenging for PE's core institutional market, right? And we've seen that where funds raised by PE shops this year have fallen about 14% in the first quarter. Larger firms in particular will continue to pursue investors that are new to the asset class. Already, firms that have invested in these capabilities, they've seen a measure of resilience in their fundraising relative to the broader market. And in the coming years, blockchain, tokenization, experimentation that we've seen there, those will all be powerful enablers that allow private equity to unlock a much broader population of investors than they've been able to in the past. So, some obvious challenges out there in the market right now, but at the same time, a lot of opportunities for PE firms to acquire some interesting assets at interesting prices. And I think it's important to remember, PE investors have survived through difficult markets before, right? The pandemic, the global financial crisis, and for some, the internet bubble. And through each one of those, firms have remained active, right? They've deployed capital opportunistically. They've made investments that have tended over time to perform very well, right? And I think that's probably the likeliest outcome from today's market as well. That's it for today. Thanks as always for listening, and I will see you next quarter with another update.
Thanks for joining the EY NextWave Private Equity Podcast. For more insights and perspectives, visit ey.com/private equity.